Guys, Jamie Dimon, David Solomon, Lance Fritz, and Doug McMillon all shared last week that the likelihood of a recession is intensifying and that we all as investors should certainly be prepared.
That's a fine theory, Mr. Ventura. What's it got to do with me?
I thought you'd never ask.
Now, if you are brand new to the channel, my name is Ari, and this channel is all about value and dividend investing. So what perfect strategies to deploy coming into 2023 when that recession is likely to hit? Now, as for today's video, I want to share a quick portfolio update with all of you before breaking down our economic backdrop, and then finally leaving you with 5 high-quality dividend stocks that you should certainly be adding to your watch list right now. Now, before we actually dive in, you know what to do. Tap on that thumbs up button and help me grow this channel. And most importantly, if you haven't already subscribed to the channel, go ahead and do so now. I want each and every one of you on this journey with me. Now, investors, let's dive right in. So the Federal Reserve has been in their blackout period, meaning we haven't received any real tidbits of massive market-moving news, allowing my portfolio to hover around $102,513.86. Now, in just a couple of days, we're going to be receiving news that I think will shake up the market, with the first piece of news to come about being the Consumer Price Index reading, which is our reading on inflation. And of course, that reading leads us right into our second market-moving piece of news, which is the news on the Federal Reserve's interest rate hike decision. Now, ultimately, across the board, we're anticipating a 50 basis point rate hike. But there have been some flurries of worries throughout last week as investors weighted a larger 75 basis point rate hike, just based on the fact that our labor market is incredibly robust. And on top of all of that, we had Jamie Dimon and David Solomon share their economic outlook, on top of Lance Fritz and Doug McMillon all sharing rather gloomy outlooks for the year ahead.
If you look in the short run, the consumer is spending 10% more than last year and 40% more than pre-COVID. They're spending it in different things, so all you speakers up here, some are doing better, some are doing worse. That's a tremendous sum of money, and they have $1.5 trillion still in their checking accounts, more than pre-COVID. So the spending is down. That's the good news. And the companies are in good shape too, by the way, and their balance sheet, consumer balance sheet is in great shape. The other news, which is not good, is that rates are now 4% on their way to 5%. Inflation is eroding everything I just said, and that $1.5 trillion will run out sometime mid-year next year. And so when you're looking out forward, those things may very well derail the economy and cause this mild or hard recession that people worry.
We're at a very uncertain time, given we're changing monetary and economic conditions very, very quickly. And that's certainly having an impact to slowing down economic activity.
I think there's no doubt that some demand is going to be destroyed as the Fed raises rates.
One wants a recession. Should the Fed do what it needs to do, even if it is a much harder landing than we'd like?
I think inflation needs to be dealt with.
You do.
Trying to come up with the equation that creates the softest landing is obviously a huge challenge. So I think our role, Joe, is to give people data and to tell them what's going on so they can make the most informed decision.
The market seems to certainly be in preparation mode as of this point in time. Now, as for us investors, it is just time to be preparing for the worst, and in the event that this is all just a wash, heck, we really have only added quality investments to our portfolios, so it's a win-win. Now, moreover, I want to share on a more personal note that I am getting pretty fed up with, say, Seeking Alpha and Motley Fool articles telling the average Joe out there to buy Coca-Cola, especially when Coca-Cola is at a P ratio of 30, and likewise with Costco with a P ratio above 35. For the love of Warren Buffett. And where does this really leave us? Not long ago, I recommended Con Edison as a safety stock, and what happened since? Well, we saw a 7% spike in a share price since November 13th. Or how about my buy now recommendation on Taiwan Semiconductors, which, by the way, I certainly took a lot of heat for, and now have a look at that share price. You would have profited over 30% of a return by buying on the day that I posted, October 30th. And now, here I am saying it's the time right now more than ever to listen in closely, do your due diligence as investors, make sure you're making the wisest possible investment decisions. With all of that said, let's break down our first dividend stock. We have Pentair, ticker symbol PNR, which is an investment that I feel flies under the radar within the dividend investor community, given it's a water treatment company. it's not exactly that exciting. However, since Pentair's founding, Pentair has expanded outside the United States and into both Canada and the UK, providing water treatment solutions for residential, commercial, and industrial clients with multiple segments from their water disposal and filtration systems to their more recent pool and spa equipment segment, all allowing Pentair to become a $7.39 billion market capitalized company. But here we are right now with Pentair currently trading for only $44 per share, which is a nice discount of roughly 35% considering Pentair's PE ratio is coming in at just 13.9. Now, with a necessity to pad up your portfolios with safer investments for the year ahead, Pentair has already begun to attract smart money, with multiple hedge funds adding to Pentair positions as we speak. As for analysts, we see the average target share price coming in at $50.20 per share, which is going to grant a shareholder nearly 12% worth of upside. And as for Pentair's dividend, which of course we are all here for, Pentair has been shelling out their dividend for 46 years now, with its current dividend yield coming in at 1.88%. Next up, we have Emerson Electric, ticker symbol EMR, which has actually been quite a volatile stock over the last couple of years from disruptions within the supply chain, given Emerson manufactures a wide variety of automation solutions from control systems and regulators to electrical components and software. But given Emerson is a global technology, software, and engineering powerhouse, Emerson has stood the test of time and will likely continue to outshine competition, just as they've been doing so since their founding in 1890. On the year, they are actually up by a little over 5%, trading for $94 per share. However, their PE ratio coming in at just 17.4, it looks like there's some opportunity. And in terms of their future, which is what I'm looking at, especially as supply chains seem to be correcting themselves, Emerson still has room to run, which we can see analysts are forecasting coming in at a target share price of $99.17 per share, making for 4.71% worth of upside. Now, when it comes to smart money, boatloads of capital is being poured into Emerson Electric. As dividend investors, we are the buyers and holders of the market to capitalize on a company's dividend, to which Emerson allows us to reliably do so, paying a dividend out for over 66 years, with their current dividend yield coming in at 2.17%. As for our third dividend stock, I cannot for the life of me figure out why shareholders have sold out of this position as much as they have. With the stock sliding as much as it did, I want to once again bring Tyson Foods, ticker symbol TSN, to your attention. Guys, we are talking about the world's second largest producer of chicken, beef, and pork, and the largest exporter of beef out of the United States. So unless the world goes 100% vegan, then I think we're in business here for some lucrative returns with this $22.47 billion market capitalized cash cow. Now, just how discounted is this stock opportunity? Well, it's down 25.7% on the year, trading for $63 per share, which is likely due in large part from their miss on earnings. But who hasn't missed on their earnings recently? And on a more positive note, they also had a positive rise in sales. Therefore, it looks like our biggest dilemma when it comes to Tyson is this imbecile of a CFO who was recently arrested for public intoxication and barging into some woman's house to sleep in her bed. But heck, if that is the headline that's scaring investors away, I say invest away with Tyson's PE ratio coming in at just 7.1, especially with analysts projecting over 17.6% worth of upside, with a target share price coming up to $75 per share, to which hedge funds seem to be sounding their buy alarms as well, scoring more shares worth of Tyson. And of course, all in the meantime, until Tyson Foods actually makes their inevitable rebound, we as dividend investors will be capitalizing on their 2.87% dividend yield. Now, if Tyson Foods didn't quite hit the spot for you, this next dividend stock has been brutally knocked down from our economic backdrop and is yet to have a run for its money. But come an economic turnaround, should perform exceptionally well. Let's dive into T. Rowe Price, ticker symbol TROW, which you may have already known is a global investment management firm offering a multitude of funds, advisory services, and retirement planning for both individuals and institutions. Now, T. Rowe Price has been a prominent financial firm since their initial founding in 1937 and has established itself well within the industry while amassing a $27 billion market capitalization. Now, like all financial sector investments, T. Rowe Price has certainly experienced volatility, but with the vast majority of T. Rowe Price's assets within the stock market and even more so invested heavily in the NASDAQ, well, T. Rowe Price plunged to levels far below its current share price, which is $121 per share as we speak, still down over 35% on the year. However, we can also see a spike in the share price, which was due to positive market sentiment and optimism when it comes to an economic turnaround. So it is in my belief that T. Rowe Price will take off when the market recovers and growth stocks get their fair share of love from investors once again, which seems to be exactly why smart money is pouring millions of dollars back into T. Rowe Price, especially right now when T. Rowe Price's PE ratio is coming in at just 13.9. Now, until the market recovers, T. Rowe Price will likely just continue to reward their shareholders with the dividend of theirs coming in at a dividend yield of 3.79%. And last but certainly not least, the elevated inflationary environment we will continue to reside in for some time. There is no better monthly paying dividend stock opportunity to double down on right now than Realty Income, ticker symbol O, with their beautiful flourishing real estate portfolio of over 11,000 single tenant commercial properties across the United States, Puerto Rico, the UK, and Spain. And while Realty Income has only recently seen some volatility with the share price sliding from roughly $73 per share to $63 per share, meaning it's down on the year by about 7%, I would say we have a nice little opportunity presenting itself, and even with a potential recession on the horizon, Realty Income's tenants from 7-Eleven to Walmart and Home Depot make Realty Income a moat-worthy investment. As for analysts, they foresee upside potential, nearly 6% worth of it, coming up to a share price of $67.25 per share, so no wonder we see plenty of hedge fund activity when it comes to Realty Income, with smart money investing more into this industry-leading $39.87 billion market capitalized REIT. But when it comes to Realty Income, what makes it a true gem for dividend investors is the fact that Realty Income has been increasing its dividend for over 25 consecutive years with a status of an aristocrat with a current dividend yield of 4.74%. Now, investors, that's a wrap. From Pentair to Emerson Electric, Tyson Foods to T. Rowe Price and Realty Income, the 5 dividend stocks that I am encouraging all of you to add to your stock watch list and invest into should it make sense for your personal portfolios. But please keep in mind that I am not a financial advisor, so please just perform that due diligence of your own before making any major investment decisions. Let me know your thoughts on these companies by dropping a comment or two down below, and of course, tap on that thumbs up button to help me get the word out there. Guys, subscribe if you haven't done so already, as I'm on a mission to get this channel to 10,000 subscribers and would love to have each and every one of you a part of the journey. Now, investors, until next time, I will see you all in the next video.